Hello, I'm James Yardley, and today I'm joined by George Curtis, the manager on the 24 Dynamic Bond Fund. George, thank you very much for joining us today.
Thanks for having me, James.
George, you guys are the bond specialists, bond experts. It's been a very interesting time at the moment in markets. There's a lot going on in terms of inflation and interest rates. At the start of the year, we were all expecting a lot of interest rate cuts to come through. That hasn't really happened yet. I mean, we've had one cut now in Europe and a few cuts around the world. But where are we now? I mean, are interest rates set to come down? What is your view?
Yeah, so I mean, if you rewind 6 or 7 months, go back to December of last year, we had what could be probably called a kind of a dovish pivot from the Fed, and ultimately this, Jerome Powell and his colleagues did this because they were acknowledging that the risks were more balanced, right? Inflation progress was still going to be bumpy and potentially slower than what we saw in the second half of last year. So the 6 or 7 cuts that the market was pricing in at the beginning of this year was too much. The Fed themselves, in their summary of economic projections last year, said they were planning on cutting 3 times this year. So the data has been pretty robust. Inflation, particularly in the US, in the first few months of this year, were much stronger than expected. But we are seeing clear signs of cooling. We had a pretty good inflation print out of the US last month, and labor data, economic activity data, in particular in the last couple of months, is starting to cool. And I think the Fed and other central banks are very aware of the two-sided risks of monetary policy, right? When the Fed tell you that the risks are balanced, they acknowledge that inflation is not yet at target, but that they don't want to cause too much weakness, particularly in the labour market, right? Once the unemployment rate starts moving historically, it can move quite quickly and can be quite difficult to stop. So we expect a first cut from the Fed in September. Around the same time, maybe slightly before that, or from the Bank of England, but we expect the cutting cycle to be relatively gradual. Why? Well, in the US, we're still seeing GDP growth of around 2%, which is roughly a potential, maybe slightly above potential, and growth in Europe and the UK is improving.
And you don't think that the US election is going to get in the way of that? I mean, some people are saying that the Fed doesn't want to be seen as political, therefore they're going to not cut in September because it's too close to the US election. You think they'll just ignore all that and just go ahead and do what they think's right?
So I think it leaves September open because it's just before the election. I think you're right. People have said that maybe they won't want to cut in November because they don't want to seem political. I would say that the environment now is difficult. Is different to the environment we've had in previous political cycles because we've got forward guidance now in a way that we never had. Right? They only introduced dot plots, which is their estimation of where rates are going in the next couple of years post GFC. You go back to a Greenspan era, in the 90s. People didn't know what had happened at the FOMC until well after the fact, right? They didn't tell you. So we've got forward guidance, and they've been quite explicit with that forward guidance, and we know that they will be led by the data primarily, right? So if the data weakens, they will cut. We think that data will probably allow them to start that cutting cycle in September, which is just before the political or the election in the US.
And where do you then see the most value at the moment? Obviously, we've got an inverted yield curve at the moment, so that means obviously you're getting a higher yield for cash versus if you lock up your money for longer. But is it worth locking up your money by saying buying 10-year government bonds, getting 4.3% or wherever we are at the moment? Is that what is your view for investors at the moment? Should you be playing that game, thinking that rates are going to come down and therefore take a slightly lower rate but lock in now?
Yeah.
Or do do you just stay shorter duration and stay take less interest rate risk, I guess?
So what we're doing in the portfolios is that we want to have duration. We want to have some duration, right? Because we want that balance in the portfolio. If for whatever reason growth and other data started to weaken more meaningfully, right? Because government bonds, kind of longer dated government bonds, would protect you in a downturn. But we want the biggest driver of our returns to come from credit, which is kind of where we are seeing, strongest returns at the moment, and actually we're seeing reasonably low volatility. So the way we are thinking about credit is that we want to be, focusing in areas that have low default risk. We want to focus in areas that in sectors that perform well in a higher for longer environment, for example, but are also well protected in a recession. And we want to focus on generating strong excess returns. So we have that balance. We have that balance between government bonds. We have that balance, but we still have an overweight, a significant position to credit, which we think is where the largest driver of returns will come from this year. For us, developed market credit in particular. And as I mentioned, focusing on those sectors that perform well, both in a higher for longer environment, but also are well protected in a recession. So we like financials, we like ABS.
And do you prefer higher quality investment grade to high yield at the moment? I mean, the spreads are not huge in credit at the moment, are they? I mean, what are your thoughts on those valuations? You still think you're just buying at these low spreads?
So you have to be, I think, quite selective in terms of how you allocate to credit. Let's not forget. Let's go back to September of 2021. The CCC rated index gave you all-in yields of 6%. Right now, you take your typical BBB rated bond in the credit space, you're getting anywhere between kind of 4 and 4.5%. Financials, you can get maybe slightly more than that. So you don't have to take a huge amount of credit risk to generate strong returns. So our kind of high yield exposure is the lowest it's been through the cycle. But there are areas where you can get both still attractive spreads and strong protection from defaults, as I mentioned, financials and ABS in particular.
Yeah, and you are bond specialists. You do go into these more niche areas. So can you explain for our viewers what ABS is and why you're excited about it?
Yeah, so I mean, these are securities that are backed by a particular asset, that are securitized on a particular asset. So of course you have kind of mortgage-backed securities, residential and commercial-backed securities. Our ABS exposure is primarily CLOs. CLOs, all they are is a securitization on a diversified portfolio of high yield loans. So you take 100 to 150 loans through European the high yield market. You securitize that, and we are taking exposure to that securitization. Why? Well, you get a very attractive yield. That there is a complexity premium there, but there is also strong structural protection. Right, in order to take, say, principal loss, right, to see a default in a BB CLO, you'd need to see a cumulative default rate in the underlying portfolio of loans of almost 30%. So you'd need to see multiple 2008 Lehman type years in a row, and this is at the same time that you are getting 650 basis points of spread for a floating rate bond. Right, so a bond that does well in this environment where rates are potentially moving lower, but at a relatively slow pace. So
what in all-in terms, the all-in yield then at the moment?
So our CLO bucket in sterling's roughly 11%, and that's after very strong performance over the last 18 months. It's been, I think, the best performing sector in global fixed income, really, for a number of reasons that make sense. We've been talking about CLOs for a long time now.
Very good. And then the other area, I think you've got quite a lot of exposures in the AT1s.
Yeah.
Do you want to explain what those are as well to our viewers and why you like them?
Yeah, so AT1s, all they are subordinated bank risk, right? So you have a bank, and a bank has a large capital structure with dozens, if not hundreds of bonds, going from kind of senior unsecured to tier 2, and all the way down to the most subordinated level, which is the AT1 bond. So look, we just view it as kind of unsecured subordinated bank risk, but it's a high quality sector, right? Because the banking sector in Europe is high quality. You look at the AT1 index, for example, it's giving you average yields of BB+, so just below investment grade. That's at the subordinated level. 95% of our AT1 bucket is investment grade at the senior unsecured level, right? So these entities are almost exclusively investment grade, issuing subordinated bonds at an average rating of BB+, and we are seeing still yields of 8.5%. So high single digit yields for a sector that is performing really better than it has at any point in the last 15 years, right? That this rate environment is a good thing for financials. Steeper yield curves, they borrow short, lend long, allows them to generate better profitability. So we are seeing now return on equity in the banking space of 11-12% versus the kind of 4 or 5% we saw during the QE era. So we've seen much better equity returns. We've seen much stronger credit upgrades to credit downgrades. In fact, Western European financials was, I think, the strongest upgrade to downgrade sector in global fixed income last year, and still highly attractive yields.
Very good. So what's your overall outlook then for the fund and for fixed income over the next year and looking forward into the future?
So I mean, look, second half of the year, we expect both the Bank of England and the Fed to start their cutting cycle. We expect cutting cycles to be fairly gradual for reasons I've already explained, in that growth and unemployment still remained in a pretty good place. We would expect growth to weaken maybe slightly in the US from very high levels. We would expect growth to continue to strengthen in Europe and the UK from very low levels. All of this is a pretty good environment for credit, right? Credit fundamentals, corporate fundamentals remain very strong, particularly up the quality curve. So we want to remain invested in kind of higher quality credit. We want to remain liquid, so we've got this large government bond bucket, which is giving us better yields than really any time in the last 10 to 15 years. We'd still expect some kind of month-to-month volatility driven by data potentially, because we know the central banks are very data dependent, potentially some kind of geopolitical vol. But we use that really as an opportunity to add credit. I think the most important thing for fixed income, you look at 3-year, you look at 5-year total returns going out, forward returns. They are highly correlated to your starting yields, right? Looking at 5-year returns, there's a 90% correlation to starting yields. So I think the most important thing for fixed income investors is now, when you're seeing yields of 7 or 8% on the fund, this I think is a good environment for fixed income, where you can generate high single digit returns, mid to high single digit returns, and do it with a lot less volatility than the equity market.
Fantastic. Well, thank you very much for joining us today, George. That's been very interesting.
Thank you, James.
And if you'd like to learn more about the 24 Dynamic Bond Fund, please visit fundcalibre.com.